I now call to order the AVA Community Energy Financial Administrative and Procurement Subcommittee meeting scheduled for today, May 8th, 2025. It is now 3:33 p.m. We are attending by remote and in person. Let's please have the roll call.
Director Murata.
Here.
Director Kang.
Here.
Director Del Contancio. Director Brown.
Present.
Director Sakakihara. Director Kaur.
Present.
We have a quorum.
Thank you. Is there any public comment?
We currently have no members of the public with their hand raised.
We'll move to item 3, which is the approval of minutes from March 12, 2025. Is there a motion to approve?
Motion to approve.
Is there a second?
I'll second.
Thank you. Roll call, please.
All right. I will now take the vote for the minutes. Director Murata.
Aye.
Director Kang.
Aye.
Director Del Contancio.
She's still in as an attendee.
You have been promoted to a panelist. Director Brown.
Aye.
Director Sakakihara. Director Kaur.
Aye.
The minutes are approved.
Thank you. We can go to the informational item on agenda. Is there who is presenting?
Yeah, how are you doing? It's Russell Mills, CFO, Rusty Mills. I think
Thank
I
you,
go
Russell.
through this everywhere, and so you can call me Rusty. And let me get into this informational item. A couple of weeks ago, I reviewed some of AVA's experience with prepay financings, and we were asked to take a deeper dive into the deal structure and highlight some of the benefits and risks. So just a quick level set on that first slide, to be slide 3, on what prepays are. It's a complex structure that requires at least 3 parties, a recipient such as AVA that receives the energy, a supplier or prepaid energy supplier and funding recipient such as a Morgan Stanley, and then a conduit issuer such as CCCFA to issue the bonds. I'll show a detailed transaction structure in a couple of slides. Just to highlight the main benefit for AVA is savings on power costs. The cost of funding with tax-exempt debt is lower than a supplier would otherwise receive borrowing from the taxable market or by using their own internal funding costs. So they provide a discount on the power supply to AVA in exchange for that lower cost of funding. So you can go to the next slide. One item of note that I did not cover in the prior presentation, but important to AVA, is a green bond designation. Since the energy transition began accelerating a few years ago, a new investment type and class of investors has grown. Investors such as pensions and mutual funds that focus on climate-focused or sustainable investments look for bonds whose proceeds align with their investment values. The demand for these bonds has really taken off in the past 5 to 7 years, and that can drive pricing benefits for the issuer as long as the proceeds can be certified as meeting green bond principles, such as the ones adopted by ICMA or CBI. So that's the International Capital Markets Association and the Climate Bond Initiative. So issuers such as CCCFA engage, and AVA along with CCCFA, engage a second-party verification entity that reviews the proceeds uses, and they issue an opinion as to a qualifying to be designated as green. And we have used Kestrel verifiers for each of the 3 prior prepays, and will again seek this out through Kestrel and continue aligning ourselves with green investing principles. Next slide. Okay, so this one is going to be very dense. So I'm going to walk us through this structure. It's very complex, but essentially the green boxes, the lighter green, are AVA and the CCCFA, and they show us paying for energy and RECs from an already existing PPA that we have in place. Then we novate that or assign it to a prepaid supplier such as Morgan Stanley. You see them in one of the teal blue boxes on the left. However, that is at a discounted price. A very important piece to this is the top left box, a commodity swap counterparty. I will touch more on this on the next slide, but having these swaps in place, it's vital for the deal to maintain savings and limit risk to volatile commodity markets. So just kind of step through it real quick here. AVA assigns a PPA to Morgan Stanley. Morgan Stanley agrees to pay the contract price to the existing energy supplier. Then CCCFA issues non-recourse tax-exempt bonds. Those bonds are not guaranteed by AVA or CCCFA. They're secured by the contractual rights and the transaction cash flows. And the bonds carry the supplier and funding recipient credit ratings. So Morgan Stanley at an A1 for our past 3 deals. And then AVA and CCCFA execute power supply agreements where AVA pays the contract price less a discount determined at the time of the bond sale for energy delivered by CCCFA. And then CCCFA uses payments from AVA to pay interest and principal payments to bondholders. So I know it's really dense stuff. Maybe I'll pause there and see if you have any questions.
Yeah, this is Director Murata. One
Yes.
question.
Please go ahead.
So, God, if I blink, I would have missed all of this.
Yes.
Very dense. So then, Rusty, if I may,
Yep.
where is, I understand us getting a discount and that's all good. But where is Morgan Stanley making money off of this?
Well, I think that they have a few different streams of income through these transactions. And outside of the commodity supply agreement, they also receive underwriting fees as an underwriting investment banking firm. And then
Gotcha.
there are small fees that are built into the deal like delivery charges and remarketing fees if there is excess energy that needs to be sold. For some reason, AVA's load can't take power at certain times. They remarket the unused power, and there is a remarketing fee. So there are fees on top of what's built into the discount for the supplied power, and they can actually make a little bit of extra fees on the side with that.
Okay, got it. Thank you. And then the next question I have is the bond, I think it's called the green bond, right? If that's correct. Is that a bond that goes out onto the bond market and then it's publicly available for purchase? Or it isn't done that way?
Those bonds are typically sold to green investors, but they are available to the public. And different issuers have different rules on who has priority over buying the bonds. Usually retail investors get a crack at some of these bonds first, and then everything left over goes to institutional investors. So it's a matter of just setting up the priority for the bond sale going into a pricing period and saying, the retail investor is going to get maybe 2 hours to put in orders, and then it moves to an institutional period. So they are available on the open market.
For how long? Are these 10-year bonds?
It's usually it's a one-day pricing event.
Oh,
Pricing period that usually lasts 2 to 3 hours, sometimes only an hour if there's enough demand that's been identified and we can open and close the pricing period. But those are available, and then they do trade on the secondary market. So you could go look for these bonds on a day in, day out basis and put in an offer through your broker dealer and buy these bonds from someone that's looking to sell those.
got it. Okay, thank you, Rusty. Appreciate it. Chair Cowher, I have no other questions.
Thank you. Are there any other questions, members?
Although it's not a question, I did just want to clarify, I do apologize for my tardiness, but regarding attendance, I am present on behalf of Newark. So my name is Julie Del Catoncho. Thank you.
Welcome, Member Del Cartacho. I think the Raisa will make note of that appearance.
Yes.
Thank you for alerting us. Uh, Should we proceed further? There are no other questions? Okay, let's do that. Let's proceed.
I think next slide. Okay, this is a list of all the parties involved, which include the few I've mentioned before, and then other parties such as legal counsel that help draft disclosure and review various documents. Bond counsel is used to draft the bond offering statement and financing documents, and also review what's very important to this transaction is tax matters. So we need to conform with IRS code so they can issue a clean opinion that the prepaid transaction complies with tax exempt bond regulations. Custodian banks are used, such as Bank of New York, which we have used on the prior three. They process all the various cash flows. Then the bonds are rated by at least one major rating agency. AVA has used Moody's on the prior three, and they rated them with Morgan Stanley's A1 rating. I did briefly mention the commodity swap on the previous slide. It's very critical to maintain the structure and savings by shielding both the issuer and supplier from commodity price volatility. So we would go out and usually there's maybe 2 or 3 of these commodity swap counterparties that are interested in doing these. And let's say an RBC is contracted with, they provide mirroring swaps. So cash flow swaps with the issuer and the supplier. So everyone's price risk is hedged. It fixes the discount and the necessary cash flows needed to pay the debt service at the time of pricing. And then the bonds can be paid through debt service payments from AVA, and the energy prepayment can be made to the supplier for a known quantity of funding. Next slide. Some of the beneficial elements for CCAs. So we can assign existing and future PPAs into the deal structure and receive a discount on that power. We assign or novate the contract to that prepaid supplier, Morgan Stanley, in this case, or in the past 3 that we've done, through an assignment agreement with the original counterparty. All other terms of the PPA remain unchanged, and then if there's an event of termination for the whole prepaid deal, the assignment agreement also terminates and the PPA reverts back to its original counterparties. However, AVA would be getting that power, but we would not get the discount on the power anymore. So that power supply is secure, but the discount is not. The debt is off balance sheet for the CCA since they are issued by CCCFA, and it's also non-recourse to the CCA, meaning it's not secured or guaranteed by AVA or its rate structure or ratepayers. This mitigates any risk to AVA related to termination events by requiring that the supplier and funding recipient pay off the bonds if there is a termination event. Maybe I'll pause one more time. More dense information, please ask questions if you have any.
Please ask questions. I will not be able to see all members on my screen, so if you can use the raise hand feature, I can call out the members and recognize them for the questions.
All right.
I don't see any hands raised, and using my screen, I don't see any questions. So
Yeah, we can go on to the next slide.
yes.
Just want to highlight a few of the risks to prepaying transactions. Most of the consultants, both legal and financial, and the underwriters, they're all paid out of bond proceeds, and they wouldn't get paid if the deal doesn't materialize. So if the bond market is too volatile, there's been lots of volatility in financial markets recently. If that would continue and the deal did not materialize, they wouldn't get paid. However, there are some out-of-pocket costs for ratings and the green bond designation that would still need to be paid. AVA does sign an MOU that details how those are split between us and Morgan Stanley. The bank would pay a majority of the majority of it if the market conditions make it uneconomic to sell the bonds and obtain an adequate discount. There is an opportunity cost risk that if the timing isn't optimal or waiting could have produced better savings, we might have an opportunity cost to having a lower discount than we could have had by waiting. There's also some risks to AVA losing load in the future or having the inability to assign future PPAs. That could create termination events, would result in the discount being lost and have the PPA revert back to its original form. And the last two on political and regulatory risks, I think that comes with operating as a load-serving entity. As a utility in the tax-exempt space, there's always a risk to changes in tax code or risks to changes in RPS standards as just examples that could cause termination events. But again, the PPA would revert back to its original form and we would face the original counterparty for our PPA. Next slide. Just real quick, just cover two quick slides on the various documents. This first are the documents that AVA needs to sign and negotiate prior to signing. Most of these are related to power supply and the PPAs, including the power supply contract and assignment agreements that insert that new supplier for AVA into the PPA, and that's not coincidental. I think if you look at these PPAs or these prepays, it's a bond transaction. It's a large bond transaction, in fact. But we are really just an off-taker to power through the whole transaction. AVA's role in this is to continue receiving discounted power into the future. And then the final document is that cost share that I described before in the event that a deal does not materialize. And on the next slide, quickly, the CCCFA documents, they are the legal entity responsible for bond-related documents, such as the trust indenture and repricing agreement, and also documents that outline various cash flows that flow through the structure, and then those commodity swap agreements that insulate the transaction from market volatility. And then lastly, I think before I walk through the timeline, just ask real quick if there are any questions on the past couple of slides.
Members, directors, any questions? Any raised hands?
Member Murata has their hand up.
Oh, thank you. Director Murata, please go ahead with your question. You're recognized.
Thank you, Chair. Rusty, couple of questions. For us at AVA, like how much are we prepaying? Like, I mean, what's the total megawatt of volume that we're prepaying for?
Yeah, I think it's currently we are looking at what structure and which PPAs to sell, but typically the gross transaction proceeds in the three we've done have been $1 billion, right around $1 billion. And I think that roughly translates to 350 gigawatts a year, if I remember right.
I think that's about right, and maybe it's worth mentioning that I think we usually size the transactions based off of the capacity of the bond market.
Yeah.
And then based off of where the forward curve is for energy, we will determine the right amount of energy that is required in order to meet that those bond proceeds. And so and we have more than ample power purchase agreements that we can actually flow through. So really the constraint is more about the appetite in terms of going to market.
Yeah, and I think to further that, Director Murata, there is a certain limitation to how much of our load we can prepay for. So if it's typically around 70 to 75% of our total load, you conceivably would convince the tax lawyers that they're comfortable enough. Gives you enough headroom. And I think at this point with the three we've done and the fourth we were planning, that would be somewhere around 40% of our load that we've prepaid for into the future. So we've got plenty of headroom left.
And to be clear, that threshold limitation of say 75% is a tax view of how comfortable they are in the risk that if a PPA would fall out, or if you had a loss of load situation, you still have ample qualified energy you could assign into that transaction. So that's the risk assessment that the tax council is taking. That's correct.
Okay, and the way that we're actually, how are we actually getting that energy? I think fundamentally, I get the prepaying concept, but how do we get it? Like,
It's delivered from the project that produces the power, or through the PPA if the PPA has a delivery point produced somewhere else, and it's delivered, let's say, just to NP15, one of the major hubs in Northern California. It's delivered the same way as if we were in a PPA structure with a developer at one of our projects that we've PPA'd for.
And I want to maybe emphasize, in all cases, the PPA actually performs the same way that it would typically perform. So we have different types of PPA contracts. So however it's delivered in our existing PPA, it is still delivered that way. It's just being assigned or novated into this structure. And technically, it is a different counterparty that's selling it to us as we novate it through. But the power itself is actually performing, the project, the generation is all performing the exact same way it otherwise would.
okay. Yeah, I think I get it. All right, thanks. No further questions.
Scott Sakakihara, welcome. You are recognized.
Thank you. And I just wanted, and I understand we are not the ones who are prepaying this amount, just locking us in, but I know we covered this at the last meeting as well, and this is in greater detail, but and apologies, I was a few minutes late as well, but has anything changed between the last presentation and this one? And this is the perfect slide to be on in terms of timeline and progress against it. I know it looks like there's the selection has happened, but anything else with our outlook on how we think this is going to play out going into June and early July?
I don't think anything on outlook. I will say there is a sort of a let's not hurry up because we may be waiting thought right now because of the volatility in the markets and where interest rates have moved around. The critical piece to selling these bonds is to have the taxable rates and tax exempt rates, like that spread, optimize and have a big enough difference. And I think right now it's compressed enough that, you know, we may be looking for this to be approved in June, and hopefully between now and then the markets will improve and we can go out and sell the bonds. But as of right now, I think that's really what has changed, is just that, okay, I don't think we need to rush this out there and try to get this approved in May, for example, and try to be in the market later this month. Otherwise, yeah, I think you're right. We did select Morgan Stanley, and we did kick off the financing process and have the full financing team working on documents and getting ready. And we do want to bring this back to XCOM in early June and then bring it to the full board in June for approval. And then we'd follow, assuming things go well and we get approval, we would then go to the CCCFA board for their approval after that and be ready to enter the market.
And one thing that may be worth highlighting here is just a distinction of when cities go out for bond offerings, you're really looking at optimal points of trying to reduce your interest rate on the bond offering as much as you can to lower your city costs. In this case, we're looking for that spread.
Right.
And so in some sense, you can always go out there because there's always a spread, but you want to try to maximize that spread to maximize the discount that we can get on our PPAs. And in volatile market conditions, the bond investor interest is a little paralyzed, if you will, and they don't really want to go buy bonds,
Right.
Generally speaking. And so it's just not a particularly advantageous time when there's a lot of volatility in the market. And as you may all be experiencing in your city perspectives, it is a very volatile time, obviously. And so it doesn't seem like right now is the most optimal time to go out to market. And therefore, we've got a little breathing room to get all of our docs and everything ready, and this is pretty typical in any bond cyclical markets, times where it's going to be a little stagnant and you wait and see, and then you want to be ready to go when that market opens up and it looks really good. And I think and Rusty, you can speak to this much better than I can, but historically, I mean, there have been times where the bond market might be closed off for a year or two. We
Yes.
hope not, but that is possible. And
During COVID, maybe for 2.5 months, it was really tough to sell any bonds. And back in the financial crisis, 2007, it was probably a good 6 to 8 months where it was difficult. I myself went to New York and came home without selling about $250 million worth of bonds. And we went back, that was in November, we went back in January and successfully sold those. But you just have to wait until the market normalizes and you can get back out and there's actually demand for the bonds. So.
And perhaps just noteworthy to say that in at least our 3 prior transactions, which we issued in 2021, 22, and 23, we were able to get out to market very quickly. So but obviously these are unique market conditions right now. So obviously that will always change. So we'll just be ready to go when it opens up.
So that's it. I guess I'll open it up for any additional questions. Otherwise, that's all I have.
Director Brown, you're recognized.
Yes, thank you so much for, going over the lay of the land. I just want to say that I think it's really detailed and it all makes sense. Currently within the city of Oakland, we are in the same kind of phase and process. And so just listening to you as far as the selling of the bonds and the timeline and all of the pre-work is very much in alignment with kind of what we're doing on our end. And so I don't have any questions, but thank you for explaining everything so well.
You're welcome.
Thank you, Director Brown. Any other questions? Are there any further slides?
No, I think the further slides are just appendix slides for the prior presentation.
Yeah, I kept some informational slides from the prior meeting as reference if folks wanted to look at, but yeah, no need to cover those again.
Okay, sure, I think we have had some questions already asked. If there are no more questions, I can open it for public comment.
There are no members of the public with their hand raised.
I will now move on then, and in that case to discussion, if there is any discussion on this item. All right, this was an informational item and really appreciate the detailed information. I think I will have to revisit it multiple times. And just wanted to ask when are you presenting this to the full board?
Bring it back in June. I'm going to bring it to XCOM first in early June. And bring it back to the full board. And I should have, a lot more detail around the transaction specifics since we'll have, the next 6 weeks to work on documents and structure.
Great, thank you. All right, I will move on to informational item number 5, which seems to be a very important item, draft budget for the year 2025 through 2026. Who will be presenting?
All right, I'm gonna present this. This is Howard, this is the process that we're gonna go through here in May and June. Looks very similar to what we do every year. I know many members here are relatively new to AVA, and this is the first AVA budget that you may be running through, with the exception of yourself, Chair and Core. So the timeline is very similar. We'll do informational reviews throughout May. We did a review with our executive committee yesterday, with our FAP today, and we'll bring it to the full board as an informational item later in May. And then in June, as we iterate on it and update it, we'll review it again with our executive committee and then take it for an action item in the June board meeting. So that's the typical process. There is some uniquenesses to this year's budget, and I think there's added complexity and uncertainty. Part of that uncertainty is due to market volatility, and part of that is related to some regulatory proceedings where we anticipate some PCIA reform. And so that adds in greater uncertainty than what we've seen in prior years. And what we have in front of us is a pretty meaty deck. I'm not going to run through every slide, but I certainly will run through the important points. I have two primary objectives. One is to simply inform the board on the various budget scenarios and the uncertainty that we're trying to navigate through to be able to provide a good forecast of our budget. And what I'll do is review two budget scenarios today. Those two scenarios, I would say, are illustrative potential outcomes. They're not definitive scenarios. There are many scenarios out there that can occur based off of energy markets volatility, based off of regulatory happenings and actions. But I think these are two pretty good illustrative outcomes, and we'll talk about one of them actually has a modest deficit that we want to manage. So objective one is just to sort of inform and update the board on sort of what we're looking at in terms of potential budget scenarios. Objective two is, in light of potential deficit, we want to discuss and present various levers and tools that we have to manage and eliminate that deficit and ensure that we're operating in the black with a positive net position. And we want to get feedback from the board on some of those options and tools that we have. And we'll discuss some of the pros and cons in doing so. So those are the two big objectives for today's meeting. I've got three sections and a brief intro section, a brief section on PCIA and what's happening there as it relates to potential reform, and then of course the draft budget itself in laying out the different scenarios and some of the different tools and underlying assumptions in the budget. So with that, let's jump to the next slide, Rice, please. I'm going to go through this first section very quickly, spend a little bit more time on the PCI section and spend the bulk of the time on the actual budget section. This is the typical categories that we go through in the budget setting process. The big highlight I'll just say is, as you can imagine, 90+% of our expenses are really related to energy. And then 6 to 8% of our total expenses are related to overhead and local development. So obviously the lion's share is on energy. Next slide. I'm not going to cover this. This is just some really kind of high-level basic information on energy delivery. So you can go to the next slide, please. This slide, what I want to highlight is just as a really quick recap. Of course, we have two main electricity products. One is R100, Renewable 100. The other one is Bright Choice. Currently, Renewable 100 is priced at a 1/4 cent premium above PG&E rates. When we launched, we were at a 1 cent premium to PG&E on our R100 product. So a modest premium, and as we've been able to build our reserves, we have been able to bring that premium down. So down from 1 cent to a 1/4 cent. So that's where R100 stands today. Bright Choice, which serves about 72% of our load, so is our predominant electricity product, which is 81% renewable energy and large hydro, plus about 10% nuclear. That is at a 5% discount to PG&E. When we launched, that was at a 1.5% discount to PG&E, and it's fluctuated a little bit over the years. At one stage, it was reduced to 1% in 2021, which was a very tight year. And then it increased to 3% in 2022, and then most recently to 5% in 2023, and it's been stable at that level since then. So wanted to highlight those numbers, and just say in the bar chart just kind of shows the distribution of Bright Choice relative to Renewable 100 related load. You can see that split both between residential and C&I, so it's there for reference. Next slide, please. The only highlight here I'll make is, we always have to manage working capital needs based off of the billing cycle. So, we deliver energy in a particular month, the bill is issued in the following month, and then typically in that third month we actually receive payment. And so there's always a working capital process and a need to manage our cash flow that's important to be conscious of. Next slide. And then you can go to the next slide. So next few slides are related to PCIA, the Power Charge Indifference Adjustment. That is a very technical item, and it always takes many, many repetitions to really digest. And so this is one of many, many repetitions. And what the PCIA is to make PG&E whole on a portfolio of stranded assets that they have due to departure of load to CCAs. That's the basic definition of what Power Charge Indifference Adjustment is. The way it's calculated at a whole is that PG&E has a portfolio of generation-related assets, and there's a cost associated with those. So that's in that blue bar of portfolio costs. And then there is a calculation related to what the portfolio value is in today's market conditions. And we're going to talk a little bit about that methodology and how you calculate the portfolio value. And that's in that sort of orange, yellowish box. And then the difference is the stranded costs. And the PCIA equates to what those stranded costs are, and that is still charged to all customers in order to make PG&E whole on those stranded assets. What is underway right now is a rulemaking with the CPUC to consider adjusting how you calculate the portfolio value. Currently, you look at the market price benchmarks across a variety of different energy products: brown power energy, resource adequacy, and renewable portfolio standard related resources. You do a mark to market on those resources over the course of the year, and you set a market price benchmark across those energy products. And then that all kind of formulaically feeds into what is the portfolio value to determine the PCIA. How you set that mark to market is critical in determining what the portfolio value is, and that is what's being reviewed right now by the CPUC, and they are considering adjusting that methodology. Adjusting that methodology means adjusting the portfolio value, which means adjusting the PCIA, which means impacting our financial operating headroom. So that's why that matters. It impacts how we set our rates, where we set our rates, and therefore what is our headroom to be able to serve our customers. And the last two bullets that I'll just highlight are, in a scenario where you have higher energy prices, energy product related prices, well, then you have higher market price benchmarks. When you have higher market price benchmarks, you have higher generation rates, and you have lower PCIA. In that scenario, AVA has more operating headroom in order to serve our customers. In a scenario where you have lower energy prices, you have lower market price benchmarks, and therefore you have lower generation rates, but you have higher PCIA, and that creates less operating headroom for AVA. That's obviously, it puts a greater strain and challenge for us to serve our customers, but it's very important to keep in mind that also means lower generation rates, so lower costs to our customers. So that is a good thing in that regard, but obviously we have to be very prudent and cautious with how we serve our customers given our energy costs. Next slide, please. So I'm not going to read through this chart, of course. This table, of course, is an eye chart. I appreciate that, and apologies for all the wording, but what we're really trying to just share is that there is a critical rulemaking right now that is opened up by the CPUC to consider changing the methodology for how you set the market price benchmarks. And right now, there's an initial phase which is specifically looking at the market price benchmark methodology for resource adequacy. And there will also be a future phase that looks at how you set market price benchmarks more broadly across all energy products, not just resource adequacy. And what they're reviewing right now in phase one does have the high potential to also look back at 2025 rates. So the calendar year that we're in right now, it could retroactively go back and say we're going to make an adjustment on 25 to take effect in 2026. So certainly concerning, and we want to be very financially cautious on how we think about the budget and prepare for that potential risk. We do think there's a high probability that the CPUC will make these changes. Next slide, please, Raisa. And this is just a little bit of key dates. We don't have to understand all these dates, but what is important to understand is that in May, PG&E will file an updated ERA forecast, which will forecast their rates for 2026. AVA indexes our rates to PG&E rates, so that's an important data point to inform the budget. So obviously we have an initial forecast that's included in this budget, but there will be a very meaningful update over the course of the next week or so. So expect that update to, of course, be fed into the June budget update for what we bring forward. And then the other thing is that we anticipate there could be a proposed decision by the CPUC regarding the PCIA rulemaking. So that could be in middle or end of May. And if that comes, that will give a very good indication of what will happen. And then there would be a final ruling in June, which is 30 days after the date of the proposed decision. That could, of course, be delayed beyond June, later this year. So anything can happen there, but that's something that we do anticipate. That's all important because, as I noted before, I'll just highlight, we have indicated a couple of different budget scenarios. They're not definitive. These are the only scenario outcomes. They're just two illustrative examples to allow us to have a meaningful dialogue here today to talk about some of the different levers and tools that we have to manage the budget. Next slide, please, Raisa. This is just to speak to the degree of the impact that we are forecasting if PCIA methodology is reformed. And that's really important to understand. So for calendar year 26, which is a little different from fiscal year, but because rates are reset on a calendar year basis and PCIA is generally set on a calendar year basis, this slide is talking about calendar year 26. For the majority of this budget deck, we talk about fiscal year 25-26, so it's a little bit of a different staggered time period, just to call out. But in 26, what we're talking about is potentially a $187 million differential between two different budget scenarios. So it's a big number. We're just showing you here, there's an upside scenario that we're going to present in these two budget scenarios, and then there's a PCIA reform scenario. So the upside scenario is in orange, the PCIA reform scenario is in blue on this bar chart, and you can see the differential for each quarter, and you can see how that adds up. So the black line is a cumulative of the differential that you see between those two bar charts. It adds up to about $187 million. So depending on how the CPUC rules on this current proceeding, it could have a $187 million type impact on our budget. So big deal outcome. It could certainly be something different than that as well. So it's not as if that's the only modeling scenario or outcome, but we're just trying to indicate it is a pretty material impact that we need to account for and prepare for. So, okay, next slide, please, Raisa. What I'm indicating here is these are the three major components that go into the PCIA calculation: resource adequacy, brown power, and RPS, which is the renewable portfolio standard, so renewable related resources. And each of these equates to, you look at the market price benchmark for each of these energy products, and then that gets fed into the PCIA calculation. And all I'm trying to illustrate here is the fact that there is a good deal of volatility in each of these products. So, we kind of show the last, a 5-year period, some of that historical, some of that on a forecasted basis. And you can see, year to year, those levels can be quite different. We intentionally left off the left axis because there's some confidential pricing information here. So we really just wanted to show the differential of what you're looking at here in the blue bars. And they're high and they're low, and year to year they change quite a bit. And you can also see they change quite a bit when you look at the different colors on just one particular graph. So if we just look at the RA market price benchmark graph as an example, the dark blue line is the forecast. The forecast is used to set rates, and then there's a true-up mechanism at the end of the year. And the true-up is, of course, based off final prices. And so you can see in the light blue bars in 2023 and 2024, they're pretty different than the dark blue bars. And that is not unusual, right? You forecast prices and then prices actualize differently in terms of energy costs. And that's the world we just live in. So the true-up can be pretty meaningful in impacting rates the following year to account for that true-up. So that's important to take into account. And then, of course, the orange bar is showing you for 2025, just as it relates to resource adequacy market price benchmarks, the dark blue bar is the forecast if there is no change to the PCIA methodology, and the orange bar is if there is a major change. So you can see that has a significant impact on what the market price benchmark is. And if there's a significant impact on the market price benchmark, therefore there would be a significant impact on PCIA and a significant impact to our financial operating headroom. So that's what we're trying to indicate here. All right, we're gonna continue to move forward. Right, next slide, please. And And in here, we're going to talk about this in a little bit more detail. I'm going to blow up this bottom left bar chart in a later slide. But just as a really quick high level, the last two columns there show the upside scenario and the PCIA reform scenario for fiscal years 25-26. So when you add up the dark blue and the pink, that's your overall generation cost that our customers are paying. Our operating headroom is the dark blue. And so you can see differences in those two scenarios. That's important. And again, we'll touch on this in a little bit more detail on the forward slide. And then the bottom right slide shows you brown power energy prices. You can see there's a lot of volatility. This is over the last 7 years or so. So just showing you some historical trends and showing you the degree of volatility that you can experience in the market. And all of this translates to the brown power energy bar chart that we saw in the prior graph that shows that year to year, there's of course a lot of volatility. So some of this information I'm sharing is just to show there's a lot of market volatility, and market volatility means different rates. And so year to year, that has a great deal of impact on our budget. And then the new issue that we're dealing with this year is this PCI reform issue, which adds to that level of uncertainty and why we have two different budget scenarios that we're laying out. Okay, let's move on, Raisa. So now let's get into the budget details and go ahead to the next slide after this one, and we'll get into the numbers. So here is the draft budget for fiscal year 2025-26. And as a quick reminder, our fiscal year is mid-year to mid-year cycle, so it's July 1 to June 30th is the fiscal period. The two left columns are for fiscal year 2025, which is the financial period that we're in right now. That's going to wrap up here in the next couple of months. The column all the way to the left is what was budget approved in the last budget at the beginning of the last fiscal year. And then the column just to the right of that are our actuals. So actuals up through a recent period, and then of course a forecast for these last couple of months. So a pretty good estimate of where we believe we'll end up for this fiscal year. And there's two things I'll really highlight there. As you can see, the operating revenue in these left two columns is significantly higher for actuals. That's mostly driven by January 1 through June 30th, 2025. Rates were higher than we had budgeted back in June of 2024. And those rates actualized higher because energy prices actualized higher throughout 2024. So that's what drives that higher revenue line item. And then of course that higher revenue line item largely drives the higher total net revenues, or our net position, which you can see at the very bottom. So instead of $42 million net position, we're looking at $113 million net position. So very healthy budget surplus, which is generally good, of course, in terms of our operating headroom. It also unfortunately means higher rates for our customers. So of course they're feeling the pain, which is why everyone is talking about affordability and why that's a challenge and why we need to address that for our customers. But it does give us a higher surplus to manage. That will be important as we think about some of the different levers we have to manage this next fiscal year. So the two right columns show the two budget scenarios that I talked about for this future fiscal period. There's the upside scenario that we call. Now, to be clear, the upside scenario is actually the status quo scenario of if there's no change to the PCIA methodology, that's the upside scenario. And that results in, you can see the top line revenue about $994 million, just shy of $1 billion. And you can see a total net position or total net revenues of about $56 million. So pretty healthy. But you can see in the PCI reform column, and I would say our general feeling is there's a higher probability chance that we're going to be in a PCI reform scenario, but there's still a variety of outcomes even under that PCI reform scenario. But this is our best estimate of what we think it will result in. You can see the operating revenues is significantly lower, about $915 million, and is actually, in fact, lower than our current fiscal year actuals at $927 million. So despite increasing load, because we're serving Stockton, Lathrop, and we'll start launching to San Joaquin County, we're seeing lower revenues. So that's really a reflection of lower rates, higher PCIA, so lower AVA generation rates, which is driving that lower top line number. And you can see in the total net position or the total net revenues, it's about negative $5 million. So we're operating at a modest deficit. Not good. That's a pretty small number in the grand scheme of things. So we have a lot of tools to manage that modest deficit. But obviously between these two scenarios, you can see there's a significant difference comparing $56 million surplus to a negative $5 million deficit. And in that PCI reform scenario, we have already taken a couple actions to adjust our results. So we have a smaller allocation to our local development funding, and we have lower hiring. So we have 7 new hires in the PCI reform scenario. We have 14 new personnel hirings in the upside scenario. For local development, we have anticipated a $25 million funding allocation in the upside scenario versus a $10 million funding scenario in the PCI reform scenario. And there's still some further actions that we need to take to ensure that we're not operating in a deficit. So those are really key things to highlight. We'll talk a little bit more detail in the following slides, but that's the big picture summary of what we're looking at. I'll just emphasize again, these are just 2 scenarios. Of course, the actual outcomes will inevitably be different from these numbers because there's inherently a lot of market volatility that we're experiencing. It could be higher than the upside, and it could be lower than the downside. But they're 2 good illustrative examples to show you a pretty healthy year and a deficit year. And we'll talk a little about the options to manage that deficit. So if you go to the next slide, Raisa, please. Ignore the table for a minute. And what I want to note here is in a deficit scenario, whether it's a modest deficit or a big deficit, you have a number of tools or levers that we can pull to manage that deficit. And that's what the sub-bullets show in that left side. So what can you do? We can adjust our value proposition. We can adjust our discount relative to PG&E. We can adjust the R100 premium in order to manage that deficit. We can also adjust our procurement levels. We have an 81% target procurement level for renewable energy, large hydro for this next fiscal period. You can adjust those procurement targets to be a lower level. And there are some ideas we have around implementing a compliance period approach that allows you to balance your procurement targets over a 2 or 3 year period. So that's a nuance on adjusting your procurement levels. You can make adjustments to your local development funding. We have made certain assumptions on that already in these 2 scenarios. You can make adjustments to your personnel and hiring. We have done that as well already in these 2 scenarios. And the last item is you can certainly take your budget surplus from this current fiscal year and put it into a rate stabilization fund to help you manage any deficits in future periods. As we already highlighted in the last slide, we have over $110 million surplus for this fiscal period. And so as things shake out and we have a better sense of where PCIA will go, we may make a recommendation for putting some of that or a lot of that into a rate stabilization fund to ensure that we have that to manage a deficit period going forward. The table to the right shows a pretty bleak scenario. It is one of many scenarios, as we've already talked about, and it's showing fiscal year 27, so going out an additional year. And we're just showing that as market prices soften and we see some of these reform scenarios take place, there are scenarios where you see an increased deficit that we have to manage. It is a little alarming. You can see the top line revenues dip actually pretty materially, and you can see total net revenues are in the $100 to $200 million range. That's material, of course. I'm not in any way suggesting that this is what we expect. I'm simply indicating that in our modeling scenarios, there are outcomes when it looks something like this. Very challenging, and we have to be very mindful of the various tools and levers we have to pull to ensure that we can operate with, in a neutral state and manage that deficit. So I'm just framing that for awareness. And as May plays out and we see some of these updates as it relates to PCI reform and otherwise are at least formalized or we have a better indication of those things, we'll be able to come back in the next board meeting and have a clear sense of what we think these numbers will be and start to tighten the band of potential outcomes. But I just want you to be mindful of the degree of deficit we may be talking about managing, and have that in mind as we think about the various tools that we have to manage that, to think just how expansive do we need to be in what we consider. Next slide, Raisa. I think we've touched on a lot of these things. These are some of the basic assumptions in our budget. We assume we don't assume any change to the value proposition in either the upside or the PCI reform in what we've indicated here. We assume a 1% uncollectible rate, which is a fairly standard percent that we usually consider. To the extent we were to go into a recessionary period, we would probably make some adjustments to that, but for now, the budget assumes 1% uncollectible. Energy costs are usually a pretty good estimate because we have a good sense of where our hedged prices are, of course, and we're looking at our open position and forecasting forward costs. So usually our energy cost forecasts are pretty reliable. It's the revenue side of things that has a little bit more uncertainty. Yeah, I think that's enough on this slide. We'll cover it a little bit more detail in future slides. So next slide, please, Raisa. So here's just looking at revenue, so the top lines. We've talked a little bit about this, of course, already. Looking at total operating revenue, you can see how that differs across these 4 different columns. There's the same columns that I summarized in the earlier slide. And I'll just again highlight that when you look at 25 and 26, it's important to be mindful of our load is increasing. Our load in fiscal year 26 is increasing by 10 to 12% relative to fiscal year 25. So despite that, you can see in the upside scenario, you do see some meaningful increase in revenues, of course, to $994 million. But in the PCI reform scenario, you can see it goes down to $915 million, which is lower than our current fiscal period, despite a 10 to 12% increase in load. So that's really important to be mindful of our growth and expansion and how to take that into account as we look at these top line numbers. I'll also just say, you may or may not recall, but in recent months, we've talked a little bit about what we look at in terms of what we forecasted in terms of revenues and expenses, and we have referenced $1 billion to $1.1 billion, $1.1 billion in terms of our revenue projection. And the reason why you see even in the upside scenario we're sub $1 billion is actually because energy prices have softened in 2025 relative to where we were in 2024. So that's lowering that top line, and certainly as a result, that's also lowering our rates for our customers. Next slide, Raisa, please. Great. So this was the bar chart on an earlier slide that we're blowing up here. And this shows the historical AVA generation rates and PCIA going back to 2019. So the majority of AVA's operating history. The blue bar is AVA's generation rate. The pink is the PCIA fee. And when you add those things together, that's what our customers pay related to generation costs. In 2019, energy prices were a lot softer, and that was relatively stable between 2019 to 2022. And then 23, 24, and 25, you can see those are materially elevated levels, all driven off of higher energy costs across the board. Resource adequacy, renewable energy, and brown power. Everything has increased over those years. And the green line, our operating expenses, are an indication of that. You can see how that's increased. You can also see that in those years, despite the operating expenses increases, the rates increase in a way where you can see our margin, which is the orange line, actually increases. And that's normal. That's what you would expect because we've put on a bunch of hedges in lower priced conditions. We put in hedges in 2019 to 2022 period, and as prices go up in 23, 24, you're able to operate with pretty strong margins because you have a lot of in-the-money power hedges. And the challenge, of course, is as power prices soften, which is what we're forecasting for 25 and 26, that squeezes our operating headroom more, because the hedges we've been putting on in this current period, 23, 24, 25, those are at more elevated levels. And so more of our hedges are going to be out of the money as we go into 26. So that adds to the sort of financial burden that we have to carry as prices soften. Again, prices softening, great thing for our customers, lower rates, but it does compress our operating headroom and challenges our financial management. It's all okay in the grand scheme of things because we have very significant reserves. We have significant surplus this year. So we have that liquidity to manage through these periods, but it's just, you have to be very mindful of how you manage that risk, of course. The two right bars are 26. The 2026-U is the upside, 2026-R is PCIA reform, and you can see the differences there. So those are the two budget scenarios that we're talking about here. In the column just second to the left, the upside scenario, you can see the blue bar is what we charge our customers. That's our generation rate, and that's 11.9 cents. And the PCIA is a smaller number, right? And when you add those things up, it's pretty in line with the other scenario, which is the bar chart all the way to the right. So it's not a huge impact to our customers. But what you can see is with PCI reform, the AVA generation rate comes down from 11.9 cents to 11 cents. And that's meaningful for us. That's what compresses our operating headroom. And the PCI itself is increased. And the customers are still paying PCI in both scenarios, and the PCI is going to PG&E to offset their stranded assets. And that's what's being discussed in the CPUC forum right now. The right part of the slide is highlighting one of the tools we have. What are one of the levers? So we'll talk about the levers now that we have to manage any fiscal deficit periods. You can adjust your value proposition, right? So if you adjust your Bright Choice discount relative to PG&E, every 1% equates to about $7 million. So if you lower your discount from 5% to 4%, you increase your revenues by $7 million. That is a tool we have. If you obviously it's a linear thing, so if you do it 2%, 3%, 4%, times 2, times 3, times 4, simple as that. Similarly, with our Renewable 100 premium, you have a quarter-cent premium. That equates to 5.6 cents for every quarter-cent change. So if you increase that premium to half a cent, you increase your revenues by $5.6 million. And again, it's a linear process. So that is one tool we can consider. Next slide, Raisa. I'm going to speed through now the next few slides because I want to make sure we save time for discussion and questions. This is our procurement schedule. We're targeting 81% for large hydro and renewable energy. That's part of our sort of board-approved schedule to get to 100% clean by 2030. In prior years, we have increased that level given a strong budget forecast. And with this forecast, we have not increased that level. So we've maintained that at a steady state of 81% in light of the potential deficit. So that's really the point here. Next slide, please, Raisa. What I will highlight as a tool that we have, if we want to consider some adjustments to our procurement levels in order to manage a potential deficit, is considering a compliance period approach. And the reality is this is probably something that we would be introducing even regardless of a potential deficit, because it's prudent when you have variable resources such as solar, wind, large hydro that produce and generate very different levels of electricity year to year, depending on the natural environment. In a wet year, you have a lot more large hydro production. In a drought year, you have a lot less. And so it's important that we have some flexibility with how we manage our procurement targets so that year to year, if it's a low generation year, you have some tools across a 3-year procurement period to try to hit your target levels. And so that's something that I'll throw out there for consideration, and I welcome that feedback when we get to discussion, is 2024, we over-procured. We're about 93% large hydro renewable energy. Our target was 81%. We're generally very conservative with our targets because we don't want to miss them, but obviously that has resulted in significant over procurement. That's always been the case. 2024, we had more over procurement than prior years, just by the way of how the sun shined, the water fell, and the wind blew. And the result of that is you could consider a compliance period adjustment that would basically give us more flexibility in 2025 and 2026 to potentially procure a little under our target levels to balance out over a multi-year period. So something to consider. Next slide, please, Raisa. I'm not going to go through this eye chart. All I'll say is that we put funds in a rate stabilization fund. We've done that historically. It's called the GASB 62. That's an accounting feature that allows you to defer revenue and recognize it in a different time period. That's something we've done historically. We have modestly put funds into that, and we would consider putting a lot more funds into that given the current surplus year if we're forecasting a deficit. We have some money in there already, and we've had varying uses for what we've put in there. Some of that is for on-bill credits, some of that is for our solar and storage incentive program, and some of that is for rate stabilization purposes. So to the extent we're running a deficit, we have an available tool there to release cash and release revenues in order to manage that deficit. We have that already with about $30 million available in there, and we can, of course, increase that based off of this year's surplus. Next slide, please. So here's a snapshot of our operating expenses. I'm not going to go in depth on each of these line items. You can see that broken up by personnel, marketing, legal, other professional services, G&A. The percentages are all relatively small. Again, these all of our overhead and local development funding equates to about 6 to 8% of our total operating expenses. I'm not suggesting it's not important, and we're happy to take questions, but for the sake of time, I'm going to kind of speed through this section. Next slide, Raisa. This is a breakdown of our energy costs. Again, you can see comparison across 2 different fiscal periods. Relatively stable. The real difference on open energy costs is we have a larger open position going into 2026. Which is why that orange bar is increased, but that's kind of balanced out in a number of the other areas. So there's reasonable stability there on energy costs overall, and in fact, energy costs are softening modestly, as we already noted. Next slide, please. This is all of our overhead. Let's go to the next slide after this, and we basically break down a number of these other sections. This is on personnel costs. I've already talked about. This is one of the levers that we've pulled to manage the deficit. So the PCI reform scenario, we have 7 additional hires, and the upside scenario, we have 14 additional hires. So pretty significant difference. This current fiscal period, actually, if you go to the next slide, we'll show that. We had 15 hires. So it was a strong budget year. We've been growing. Our overall staff size is estimated to get to about 98 people. I shouldn't say estimated. It is getting to 98 people with all of these additional hires. We filled 10 of the 15 roles, so we're still actively recruiting. As is typically the case, we kind of back end recruit and fill those roles. So that's how our hiring looks. Next slide, please. This is non-operating income. So this is related to things like local development funding. And you can see a material difference there in the 2 scenarios, where one scenario we're adding $25 million to our local development funding, and the other scenario we're adding about $10 million. That's the biggest difference there. If you go to the next slide, please, Raisa, and then we break that down. Historically, we've allocated about $25 million, at least over the last couple of years. A couple of things to be really mindful of. We did our local development fund reconciliation recently. We have about $60 million or so already in our local development funding. So in both of these scenarios, it doesn't actually impact at all what we're executing on in terms of local development. So actually, if you go to the next slide, right, so that'll highlight that. So this is what we're actually spending on local development for the next fiscal period, upwards of $28 million. We have a lot of funding there, and we're executing on a lot of programs. So the prior slide is talking about allocating additional funding on top of our existing $60 million. So while there's a big differential there, I want to highlight, of course, there's already a lot of funding there. And the reality is we're in execution mode on previously funded commitments. And so what we're really talking about is we need to kind of plan a little bit more for future phases. And so we're suggesting a slowdown of that funding for this year as we do that, particularly in light of the deficit forecast in that scenario. So next slide, please. So next steps, we're going to review this with a full board, and then we're going to obviously get some meaningful updates we anticipate throughout the month of May, and make some updates to this for the June review, of course. And I think that's the last slide. Am I right? Race, anything else?
Yep, that's it.
All right, so that is it. I know that was a lot to throw at you. I apologize for the rapid fire there, but I'll stop and take questions now.
Director Scott Sakakihara, you're recognized.
Thank you, Chair. Thanks, Howard, for the in-depth presentation. I'm sure we could do like a whole primer just on the considerations going into the PCIA changes, but in the interest of time, I guess, I don't know what the short version is, but I'm interested in kind of two pieces of it. One is who's pushing this? Is this like PG&E wants this or IOUs want this because then they get a bigger PCIA? And then the other is particularly the retroactive part seems weird to me, where like they could decide in December that for all of 2025, it should have been this other calculation. And so am I understanding right that there's essentially like a double hit in 26 in that scenario where they're truing us up for 25 and then also the 20, it would impact the like go forward 26 rate, but that all is reflected within 26.
That is correct. Yeah, it is the IOUs pushing this, and they are having traction with the CPUC as the CPUC has agreed to do a rulemaking on it. That doesn't mean it's necessarily going to be the outcome, but as you heard, that is kind of what we anticipate directionally, at least. And to your second question, yes, it is. Now, it's not. It is typical process to do a true up at the end of the year. So even without any PCI reform, as energy prices soften, there's a true up at the end of the year that says, well, prices actually soften. So, you know, we're actually only charging customers what we actually need to charge them. There's always a true up process at the end of a calendar year that goes into effect the following year. And if prices soften, that means technically over collected, and we're going to charge you less next year. And, you know, so customers' rates will balance out in that regard. So even without PCI reform, there is that true up mechanism to account for that. But the reform, yes, does go retroactive look at 25. And I agree with your reaction of that seems odd. That's not typical, but it is what is being considered. Yes.
So is there no world where they would decide, yeah, this has been unfair, whatever, we're going to change it, but only on a go forward basis. So it impacts us for 26, but only for the 26 rates, not because they're truing up and spreading out over 26.
Well, certainly anything is possible. They seem to have indicated that that's not what we anticipate, given what they've kind of spoken to, and that's not official by any means. But they've indicated that they're looking at this, and it's possible to say no, we won't do it on 25. We'll just do it on 26. It's not my best guess, but absolutely, there's a range of outcomes. That is
right.
possible. Yeah.
And I think I might have asked this the last time PCIA came up, but just as a refresher, in the long run, does this go away when PG&E can no longer say, like, we're the reason why their existing like 20, 30 years timeline where they aren't committed to anything anymore in the pre-CCA world?
Yes, over time, the portfolio of assets shrinks because contracts roll off. But unfortunately, we're talking about a 20-year period. And there are assets that do still exist after that because there's utility-owned generation, which is longer lived than just 20 years. They're not just 20-year power purchase agreements. But it does fade meaningfully by like the 2040-ish time frame. So we still have a good 15 years ahead of us to deal with this issue.
Got it. And some of these are about specific slides, but there was a table you had on slide 20 where I think for one of our electricity products, we save more for every increment of change in 27 versus 26. And for the other, it's the opposite. Yeah, that little table in the bottom. So am I interpreting that correctly, that we're basically projecting or first half versus second half of the fiscal year, we use more energy, but it's cheaper? And so that's why one's tied to a percentage and the other's tied to like an increment of usage.
It's a little different than that. So what we're saying here is if you change your value proposition, so Bright Choice is at 5% discount to PG&E. If we change it to a 4% discount, that totals $7.2 million more revenue to us because you're increasing your customer rates by shrinking that discount. And what we're showing is that if you make that adjustment for just half of the year, it's not just dividing by 2. So that's what we're trying to show. Because these changes that we're talking about may take effect in 2026, there's a scenario where we say, you know, we don't want to change the value proposition for this current calendar year. Rates are actually changing in 2026. So if you did it for the whole year, it would be $7.2 million, and you'd be adding up that 4.169 and the 3,009,000, and that's your 7.2. But if you just made that change, say on January 1, you'd actually increase your revenues by $3 million just for that 6-month period from January 1 through June 30th. And we've done that same breakdown for the R100 premium.
That part makes sense to me. I guess what I was saying is just that if you look first half versus second, the 1% change in the Bright Choice product, the first half is more than half, right? Whereas for the other product, the second half is more than half. And so the way I'm reconciling those two is that in the second half of the fiscal year, we expect to use more energy, but cheaper energy. And so like the 1% is based off of the cost and quantity, whereas the half-cent per unit is based off of total quantities of usage, essentially, right?
Okay. Yeah, it's really based on demographics, and maybe I'll say let's follow up on that so we can just review those numbers. In general, the first half is your summer months, and it tends to be a higher load. So generally, I would expect first half to be a little larger, but the fact that R100 isn't quite split that same way, let us just make sure we review that and get back to you to answer.
Yeah, and if we kind of take it on a sidebar, that's fine. Then I would also just add that I've always kind of been curious about how to think about those two, right? Like I know because the amount of usage and the price fluctuates that you can't say, oh, half a cent equals this percentage, because it's going to vary depending on time of year and all that stuff. But is it even useful to think of a quarter cent as comparable to a 1% difference in the other product, right? Because I know it's not apples to apples, but are we like significantly impacting one group's bill versus the other, right? Like just kind of putting it on some sample bills to kind of understand how that would be useful, I think.
We can size that comparison up for you as a follow-up.
Yeah. And then I think your broader point though about the budget, it sounds like just, revenues dropping faster than costs because we have PPAs, we have hedges. Basically our costs are like significant portion of them are fixed in the short term, at least. So even as market prices drop, revenues drop, we're not seeing that same drop in our energy costs. And so I guess given what's gone on just the past year, is there any thought about what the ideal, I know there's thought about what the ideal exposure to open market rates is, but has that changed our thinking at all, like the current trends? Because me being new coming in, I would totally get why we want to hedge and sort of prepay and do all these different arrangements as much as possible. But it does create this interesting tension that you pointed out, where if we were more exposed to open market rates, the organization would be more aligned with customers in terms of when rates go down, our costs go down and we don't mind as much, right? Whereas now, obviously, it's a good thing to have, when rates were going up. But obviously now we're going to feel it a little bit when rates are projected to go down.
Yeah, and I'll say this is one of the areas that gets the most review on an ongoing basis. What's our risk management process and strategy? And we are constantly evaluating and tinkering with that. And I think as is, we have more open position than would be typical for, say, a municipal utility, because we're accounting for PCIA related resources and assets already. I think it's an open question of whether we want to further that. And part of that is to make sure that we're estimating what those PCI related resources are and what they generate. So we're sizing that more precisely. So that's always an ongoing piece of work. And the other is, I think there is some consideration for, do you want to increase your open market exposure? That means year to year have a little more volatility, but actually that may be more prudent in light of the rate setting methodologies.
Yeah, and it may be, coupling that with having a bigger rate stabilization fund or reserve balance that you can weather through a year or two of tough markets. So, you probably just look at it holistically and say, that we're gonna change our strategy on procurement, but we've got the ability to weather that with reserves.
Yeah, and of course, you also have to add in just the mix of that we have certain compliance obligations that require us to sign long-term contracts and lock things in. And yes, you can structure those a little differently to have a little bit market volatility in there, where they're indexed versus more fixed prices. And we try to diversify our portfolio so we're not too concentrated in one structure versus another. But you could rebalance that a little bit in light of your comments. Yes.
And to the point of the rate stabilization fund, in the interest of time, happy to kind of defer this, but this whole GSAB 62 fund, would love to understand more of that later. But I guess the bottom line is, do we have complete control over when we can recognize the timing of that revenue recognition? Okay.
Yes.
Cool. Then my only other thing was just the power content label. That's it looks like it's the AVA specific power content label. Who calculates and finalizes that?
We do, and we're in the late stages of finalizing that. So that's technically an estimate now.
The CEC approves it.
Yeah, CC approves it, but it's our calculation, yes, and it gets audited. So
Correct.
Yeah.
Perfect. Okay. Thank you. Appreciate it.
Thank you, Director Scott Sakakihara. Any other questions in the room? No, online? Hey.
Member Brown has their hand up.
Oh, I'm sorry, Member Brown, you're recognized. Thank you.
Yep, no problem. Thank you so much. I think my first question had to do with kind of what's taking place with the CPUC and the review that's happening. And I guess I was just kind of curious if the AVA team is doing any advocacy work towards a certain position there that would kind of be best for like what you all would like. And then I think it also was leading me to, I was grateful to see one of the charts that kind of laid out like, oh, what was this in 2019, 2020, just to kind of get a little bit of a broader kind of understanding of, where we've come from. And so I think as a new member, as we are making some of these decisions, I know that I always kind of look because we kind of went through the pandemic, right? So you had before the pandemic and then going through that and just kind of seeing like if there's been any impacts. And so I think I just wanted to say out loud that as we kind of move forward with, I recognize that a lot of this is going to be in flux based on the dates that things may be finalized, hopefully towards the end of June. So, I think all in all, we get to kind of wait to see what's finalized kind of in that space. So that was kind of my first kind of inquiry.
On the first question, yes, we are doing a lot of advocacy work with the CPUC, very actively engaged in our regulatory forum in general. Both our team, but also we work very closely with other CCAs and Cal CCA, which is our sort of policy membership group. So we're filing comments, filing testimonies, filing rebuttals, and we will be reviewing that proposed decision in detail. And we're also doing ex parte meetings with the various commissioners. We've done that historically. So yes, very actively engaged on that front to advocate for certain positions. And there's a lot of nuance there, of course, that we didn't get into detail here, but we are working that to try to get a favorable outcome for favorable and fair outcome from our perspective.
Okay, good to hear it. And it was great to attend the conference where I also got to engage kind of on this subject. So love to hear that. And is the exact hearing date of this, is it on the 12th?
It's not certain. They have certain calendar dates where they plan to issue proposed decisions. That's not to say they definitely will. They may delay it for any number of reasons. They just need more staff time to review it. They may do it for procedural reasons. So TBD, we just highlighted some dates that we could expect something issued.
Okay, sounds good. Thank you so much. And then, I'll hold my last question because I think I'll wait to kind of hear back kind of from those updates. But thank you so much.
Thank you, Director Brown. Any other questions online or in the room?
There are no other questions, but I do want to mention that we have not yet taken public comment.
Oh, thank you so much for reminding me about that. Really, we can go to public comment since there are no questions.
There are no members of the public with their hand raised at this time.
Thank you. Any discussions, directors? No. Okay, so I just want to take this opportunity to thank you for all the work that Ava does, especially the finance committee. This surplus thing, being on a committee that has a surplus, is hugely refreshing, especially in this climate where a lot of cities are struggling to address budget deficits. So I think this goes to speak for you, Howard, and your leadership. Really appreciate it. And the finance committee, Rusty, it's fantastic. The information that's coming out. I know that we are still addressing many issues, but I think that given the talent that we have here in the room, I think that we are in good hands. Really commend you for that. Thank you so much.
Thank you.
Thank you.
All right, in that case, we can go ahead and adjourn. Oh, actually, sorry, are there any committee member or staff announcements, including requests to place items on the future board agendas? Okay, seeing and hearing none, I'm going to go ahead and adjourn at 4:49. Meeting is going to be held online, again virtually, as well as at the address provided. And please make sure your calendars are up to date and that it has been added to your calendar so we can make quorum. Thank you, everyone.
Thank you.
Thank you.
Bye-bye.